Hey, good morning, everyone. Marty Missouri here. It's the 13th of September, 2025, with your end of week update. Folks, I'm going to jump around a bit this morning and stick, I think, mostly to the charts. Try not to take too long. There's always too much to talk about to do it in one sitting, if you will. But, interesting data came out this last week. Interesting market reactions and so forth. So let's start with inflation. The chart in front of you is CPI, which came out on Thursday. Headline CPI rose year over year to 2.9%, monthly 0.4%. Now, those are not numbers that would have you screaming at the Fed to be cutting interest rates next week, by the way. The core, which X's out food and energy, was up 0.3% month on month, up 3.1% year over year. The PPI, which I have on this panel here as well, month over month surprised and actually went down. That's the producer price index. On a year over year basis, the producer price index 2.8 and 2.6 respectively for the core and the headline numbers. So producer prices surprised to the downside. I think the market liked that. Consumer prices came in a bit to the upside, and the market didn't scream bloody murder, and I'll tell you why. In fact, the day this came out, the equity markets had a pretty nice day, and you'll see why in a minute. With regard to inflation expectations, CPI swaps have rolled over. Since last week, they were beginning to roll over from this yearly high right here. But look at this big decline right here. That was on last Friday's much lower than expected jobs number. And then here we are ticking up a little bit here at the end of the week. Yet the blue is the 2-year expectation, or compensation, if you will, 2.9%. The 5-year is at 2.63%. The 10-year is at 2.55%. All of them notably higher than the Fed's 2% target. But I will tell you that the odds of a 25 basis point cut next week are 100% priced into Fed funds futures. You will at least get that. Last I looked, it was about an 8% chance of 2 cuts. A lot of people are screaming about 2 cuts because of the employment data. Now, on Thursday, what we got a surprise hike in weekly jobless claims. And so the market looked past the too hot CPI for a Fed rate cut. I'm sure most analysts and economists would agree with that, but focused on weakness in the labor market. So we saw that certainly in unemployment claims. While I have this chart up, notice that I have these over the years, these upward sloping trend lines that precede every single recession back to the mid-70s. Okay, so without exception, when we've had this kind of move, we've had a recession, and you can see continuing claims continue to rise as well. The other thing that has been ticking up here is the unemployment rate. Again, we looked at this last week, but 4.3%. But look at the trend, and then here are all the recessions back to the 80s. You can see, with the exception of COVID, although it was flattening out here, I guess, with the exception of COVID, you had a trend, and this one's extended, of rising unemployment right before we got into recession. So big warning flags. And again, times have changed. The political will to just print away all your problems and run 7% deficits. It's tough to have a recession when the government is overspending to that degree. So we'll see what happens. But right now, the underlying data is suggesting that recession risk is far too high to ignore. And that's emboldened, the futures market in terms of Fed rate cuts. So quite the push and pull between inflationary risks and a weakening economy. And by the way, the sum total of those two things is called stagflation. That's not generally a good thing for markets. Sudden bullishness in the equity market, presumably based on a very weak jobless claims number on Thursday, although the market sold off a little bit on Friday, but Thursday was a really big up day. Let's take a look at the history of Fed rate cuts and the stock market. So here is the Fed cutting interest rates back here in the early 90s. Here's the Fed cutting interest rates before the tech bubble burst. Here's the Fed cutting interest rates before the Great Recession. Here's the Fed cutting interest rates before the COVID shock. Now, isn't that interesting, by the way? Clients, I don't know if you'll remember all this, but back here in August of 2019, we started getting conservative after being aggressive a decade. And we started getting conservative when the stock market was at all-time highs. Why? Because our data were telling us that recession risk was high and the corporate debt market was an unmitigated disaster. Worse in our view, believe it or not, than the consumer debt setup going into the Great Recession. So we expected something really, really bad to happen. And the Fed all the while was saying the economy is great. Well, folks, this was long before COVID. This was June of 2019. While they were saying one thing, they were doing another. And the reason they were doing another is because they were seeing the data that we were seeing, and they were scared out of their minds, I think, about the horrendous setup in the corporate debt market. So we were expecting really, really bad things to happen over the next, say, 6 months to a year from that point. And we actually were short junk bonds, which was paying off very nicely. And the reason we had that view is because the Federal Reserve Act does not allow the Fed to do anything other than what they did back here, and that's buy mortgage-backed securities and U.S. Treasuries. They can't step into or let's say they couldn't, to that point, step into the junk bond market or the corporate bond market at all. Well, they breached the Federal Reserve Act, in my view, and they figured out a way, working with the Treasury, to create a special purpose vehicle, fund it, and buy junk debt, and then just print money like previously would have been unfathomable. And so, hence my point again, when the market is being flooded with liquidity, hard to have a recession or hard to keep a recession going. So it was just a blip, but as you'll see here, it was a blip, but it was a big blip for stocks, down 35% if you're just looking at the S&P 500. Okay, so again, here is when the Fed is cutting interest rates, right? And everybody gets bullish as can be. And back in here, when we were beginning to get conservative, I was telling you on the videos that we might look stupid for a while because I think the Fed sees what we see, and I think they're going to probably cut interest rates. But this is an environment we do not want to swim in because of the recession risk. And sure enough, you can see here, the market went up on the Fed rate cuts, right? Right in here, when the Fed started cutting interest rates, the market went up. Right in here, the Fed started cutting interest rates. I don't know, the market pretty much had done all it could, and this is when the U.S. equity market was at valuations never seen before until now, by the way, which I've shown you upteen times. And then here was the mild 1990 recession, early 1990s. It was a mess for the bond market in here, but about a 20% decline is all we got in stocks there. Here's my point, though, folks. Here is the Fed cutting interest rates, and here is the market going down 20, 50, 60, call it 35%, although that was COVID is a whole different conversation. So what's going on here? Well, what's going on is the red shaded areas. So if indeed these employment data and other things that I'm showing you are concerned, if they ultimately do morph into a slowdown in the economy and a red shaded area on my chart, we should expect stocks to suffer going into that and during that period, particularly when they are at all-time high profit margins and the outlooks for earnings are ridiculously high. So like I said in the written post here a day or two ago, complacency is creating a silence that is deafening to me amid, conditions that I'm showing you are beginning to look a little bit concerning to us. So all in all, the soft data seems to be picking up. So sentiment seems to be getting better in some of the data that's showing up in our index. The hard data, not so much. So we'll see how all this shakes out in the coming months. I mentioned again volatility. Here's the VIX, the volatility index that tracks implied volatility or the cost of that inside of S&P 500 options. This one goes back just the last 5 years. And I was doing a different analysis when we had these circles. It was during the bear market in 2022. And every time the VIX dropped down to 20, it would spike. People would use that as an opportunity to continue to sell into what was a really ugly market. It was down almost 30% from peak to trough. And now we've been settled into these very low VIX levels, or at least low relative to where we were in 2022. But what I'm showing here, though, is a divergence that has been happening the last 5 years before market stress or before corrections happen in the U.S. market. So you can see a higher low on the VIX. And by the way, the rest of these are VIX futures. This is the spot VIX right here in green. And so you can see a higher low, and we had some corrective action there, higher low there, and then a lot of corrective action in there. Higher low there, market corrected, higher low, blip, higher low, blip, high single digit, low double digit declines. Definitely a divergence here before that 21% decline earlier this year. And here we are at all-time highs, and here the VIX is forming a higher low. So, just something to pay attention to, and comports with the concern that I mentioned in the written blog a day or two ago. Okay, so gosh, there's so much more we can talk about, but it would take all day. So I'll stop with that because I think those are key to the near term in terms of what we're looking at for the market and what the risks are. But again, the bullish narrative is that the Fed pulls it off and they cut interest rates perfectly. They avert recession. AI builds all kinds of productivity for companies, and the soldiers in the market that have gone nowhere the last few years start catching up to the generals, which are the top 7 or 10 stocks in the indices, and everything's well, and you've got a Goldilocks scenario. And I say that it might sound like I'm a little tongue-in-cheek, but no, I think with the type of money that the government is spending, and will continue to spend, and certainly will ramp up if indeed we see some serious weakness in the economy, everything may hold up pretty well. Not a lot of upside, by the way, for stocks in that scenario. You may think so, but in the scenario, save for a ton of productivity gain, these valuations do not support extended bull markets from here, as I showed you the last 2 videos, I think. And that scenario does support, again, forget about the productivity comment I made. If you just have all else equal and no real slowdown, inflation ain't going anywhere but higher. And that is problematic at these valuation levels. So our base case, though, is actually that the economy is weakening. The Fed's going to have to cut, and we're going to have to be really seriously on the watch for a recession over the next few months, which would be probably pretty ugly for the equity market. Okay, so the S&P 500 on the daily chart, we still have long divergence and momentum, as I've shown you lots. You have a rising wedge pattern. I'll have to draw that up here again. At all-time highs, just off of those a bit on Friday. Almost overbought here, but a bearish divergence there. This just says the market's heavy. Don't really have a sell signal right here, but a little bad news, and it could get pretty ugly in a hurry. NASDAQ, pretty much the same chart, just dipping its head into all-time territory finally with bearish divergences or negative divergences in momentum. The dollar is responding to the prospects for lower interest rates in the U.S. and perhaps a stabilizing economy in places like Europe. So we'll see how this plays out. I don't think the U.S. gets to have a recession without the rest of the world following, I will say. But right now, there's strength in other currencies, weakness in the dollar, which has been great for our core portfolio this year so far. The yield, as you can see, is responding to economic data, although we had a pretty big pop on Friday in the other direction, but still definitely down in the yields reflects weakness in the labor market, I think, more than anything else. Gold has been absolutely amazing. We have firmly broken out of this trading range into all-time highs. We do have momentum rolling over. We are very, very overbought. Remember, I showed you last time, here it is again. In the last 50 years, we've never been overbought like this without a significant decline in the price of gold. I am a bull on gold. I say that, I think, every week. on a longer term basis, very much so, I think for very good, solid reasons. Technically speaking, I will be surprised, despite all of those solid reasons and this new sentiment toward gold, I just would be really surprised if we don't see a pretty good give back over the coming months. Folks, let me stop right there. If anything comes up as I continue my weekend exercise that I think would be interesting to share with you, I will. Thank you as always for watching and listening. Hope you have a great weekend. Take care. Bye-bye.